Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Good morning, everybody. It's a bit of a welcome back. I think not only a welcome back to all of you, hopefully those that have already been on holiday have enjoyed it. Those that are going away, I certainly hope you get the good weather that we've seen over the course of recent weeks. But it's also a welcome back to Piers Leslie. We'll be doing the technical presentation after my fundamental presentation. And we hope that there will be a lot of interest in both the fundamentals and technicals, given that there's been some fairly significant moves in currency markets and also in interest rate markets over the course of the last sort of 6 to 8 weeks. So without further ado, we're going to dig straight into the detail of my fundamental presentation. So I'll look at, first and foremost, the macro forecast, then we'll look into what's happening on inflation. Then we'll look at interest rates and what's gone on there, because there's been some developments in both the US and the European interest rate markets that have been of interest. And of course, we've got the Bank of England meeting coming up this week. We'll look at yields as well in terms of both the 5 and 10-year government bond yields for the major markets and what might be happening there. Before turning our attention to euro and sterling that have featured in the very beginning of the presentation in terms of the title, and then look at FX markets more generally with some updated forecasts. As has already been indicated, if you do have questions, please pose them as we go along. Don't wait until the end. So looking at the first slide on macro forecasts, these are the OECD's updated forecast for global growth and also the major economies. And they've been downgraded again, downgraded for 2022 and also very much downgraded for 2023 when you look at the UK, where flat growth is expected for 2023. Now, where I think there is some room for manoeuvre and some room for further worsening is in the 2022 forecast. I mean, nobody would have had that the US would have gone into 2022 and the first half of 2022 with 2 consecutive quarters of negative economic activity, but that's where we are, which makes that 2.5% US GDP growth forecast far more challenging to achieve. In the euro area, although we've seen stronger growth in the first couple of quarters of 2022, the situation as far as confidence, as far as economic activity, and the PMI surveys, all of those seem to be worsening fairly dramatically. In fact, manufacturing PMI is now below 50, so indicating a contraction for the manufacturing sector in the euro area. And for the UK as well, we've seen the retail sales numbers continue to worsen. We've seen the environment for industrial production and also for services output further worsen as well. And so I think it's unlikely that the UK will achieve the 3.6% growth rate that's predicted for it in 2022. And that creates conditions that will make it harder for the central banks to justify the monetary tightening that they may want to achieve over the course of the coming meetings. If we look at one of the reasons for that justification, which is the next slide, then that is all about inflation and the overshoot of inflation. And we've seen that the UK's inflation rate has continued to exceed that of the US and Europe's inflation rates. But let's be honest, all of the inflation rates are bunched fairly close together. So it's not as if the UK is in a position where its inflation is significantly above that of Europe or the US. And so it's not down to things like Brexit. It's not necessarily down to things like significant currency weakness of sterling, which is relative to the weakness that we've seen in the likes of the euro and other currencies. In fact, this is all being driven by a supply side shock, which is affecting the economies of the Western world materially equally. There's very little difference between the effects that we're seeing on the UK, the US, or the Eurozone. And notably, we are going to see some significant increases in the prices of agricultural products as we go into the autumn. And there is still this differential between what's happening in consumer price inflation versus average earnings growth, which means there is a substantial real terms cut in household disposable incomes that continues to undermine consumer demand. And I think we will see that continuing to affect things like retail sales and services growth over the course of the second half of this year. Moving on to the next slide and looking at interest rates and interest rate expectations, these have moderated considerably. So previously, the peak for the US was closer to 4%. The peak for the UK was closer to 3.5%, and the peak for Euroland was somewhere in the ballpark of close to 2%. They've all come down about a half a percentage point as recession risks continue to grow. But rates are still seen as rising much further from here. So up 3% for the US, whereas at the moment they're in around the 2.25% region. For the UK and the Bank of England meeting, the central market expectation is for rates to rise by 50 basis points to 1.75%. I'm still not convinced by that. And I'm also not convinced by how much additional room the European Central Bank will have to raise interest rates. They've only just got deposit rates back to zero. And I think there is limited scope for additional tightening from here, given the deterioration that we're seeing in the European economy. If we look at this now in terms of the next slide and what's happening in yield markets, it doesn't look particularly stark in terms of the scale of the rise that we've seen versus the dip in yields. But it is worthwhile mentioning that some of these dips are 30 basis points or more over the course of a period of only a few weeks. So it does demonstrate that the bond markets are becoming less convinced about the need for additional monetary tightening from here on. And more importantly, I think they're paying more attention to growth versus inflation. So the inflation risks are seen as dampening because of the damage that's being done to particularly things like discretionary spending. And that's across all of the major economies. If we move on to the next slide and just look at what's been happening for euro dollar and sterling dollar. So euro dollar dipped briefly beneath parity over the course of mid to late July. Dipped below 118. It reached a low of, I think, 117.60. We are now back in the sort of 102 region for euro dollar. We're in the 122s, low 122s for sterling dollar. But the recovery for sterling and the euro against the dollar has been pretty lackluster, in my opinion. I think in the short term, over the next sort of 3 or 4 weeks at least, there is still some additional downside risks for both euro dollar and sterling dollar before we start seeing some of the problems for the US economy exerting themselves. So I'll move on to my final slide, and I know it's been a whistle-stop tour, but these are just some of the updated forecasts that we see. Now you can see that by the end of Q3, we've got sterling dollar and euro dollar higher than where they are currently. I would say the risks are that that doesn't materialize, and it might take until Q4 before we see the dollar under any sustained pressure. We've also got dollar yen heading lower, having reached sort of 136, 137 area in dollar yen. We've got it going back down into the sort of mid to low 120s over the course of next year. Again, there are some significant risks here around COVID. I think COVID could cause some problems for Japan going forward, but means further shutdowns and further restrictions on the Japanese economy that could prompt additional currency weakness. The other thing to watch, and I keep flagging it, is dollar China. Dollar China at the moment is not doing an awful lot, but I think there are some downside risks as far as dollar China is concerned. Sorry, downside risks to the Chinese renminbi, upside risks to dollar China, which could put the levels such as 5 or even 690 within touching distance before we start to see any sustained downside in dollar China, and it will come more because of weaker dollar rather than a stronger Chinese renminbi. So just watch out for all of that. I think it's going to be a very, very busy second half of 2022. I certainly think that volatility is still the key watchword as far as currency markets are concerned, because there is an awful lot up for grabs over the second half of this year, particularly in terms of a stark difference in where interest rates actually head versus what is currently expected, and that could cause some significant sell-offs in the major currencies over the course of the next 4 or 5 months. Now, as I say, a whistle-stop tour, but I'll stop talking now and I will hand over to Piers Leslie, who will give you the technical outlook on where he sees things from a chartist perspective. So, Piers, over to you.
Thank you very much, Neil. Fascinating stuff as ever. So I'm going to look at the market slightly different to Neil. Neil takes all the published information and forecasts of where they think central banks. I look at the price action. So if we look at the first slide I've got, as usual, I'm going to start with the dollar index and let's see what's happening in the world's main traded currency. Last webinar I was on was in June, where I highlighted this chart at the beginning of June. It's the Ichimoku cloud that we've looked at each time this last few webinars. We had the lagging line and price both above the cloud. So that was positive, as suggested dips would find support and look for dollar strength to come was the story I was giving last time. We can see that dollar strength did come and the dollar did strengthen a lot over the last couple of months. But it suddenly stopped. And if we look at the next slide, we'll find out why it stopped, where it stopped. So that big black arrow is the 76.4% retracement, Fibonacci retracement of the collapse we've been watching for some time. So we've been watching the 38 to 61.8% for the last 7 years. It's all in those circles. When you get the slides, you'll see this much clearer. But I warned back in the beginning of June, the risk was that could break to the upside. It broke the 61.8% in June, and that also meant the quarterly close was above the 61.8%. So you saw a mad rush into the dollar, because that's a signal to buy the dollar. It went up to the 76.4%, and some people took profit. And so that's causing this pullback that we're seeing back lower on the dollar. But at the moment, I'm looking at this as a pullback within an uptrend still. So I would imagine that as price comes down, we will start to see the 100, 101 area start to see some good support. It might not even get that far. You might find 104 holds it. But the main thing is to watch now, is this just going to be a pullback to the old breakout level before going higher, or is this a reversal? At the moment, I still think it's a pullback, and then you'll see further dollar strength later in the year. And I still think I have 112 as a target on the dollar index to come later. So that's just looking at the dollar index, just trying to say, what does it look like as a basket against all the currencies? But let's look at euro dollar, because that's an actual currency people trade. And so on this chart here, I'm looking at the monthly chart. And on this monthly chart, we can see that price has gone down, as Neil was saying, and went below parity, very short term. Now, in June, I said that the quarterly level was 103.83. Now, that's a key level. You need to see a quarterly close below that to open the moves down to 97 and 0.90 potentially. Now, price didn't close the quarter below that 103.80 area. It actually closed back up in the 104s. So the confirmation signal of the move lower wasn't given. So at the moment, there's a slight risk that we see a pullback higher. And we see that on the monthly chart here because there's a bit of positive divergence on it. The RSI, the Relative Strength Index, isn't confirming this last move lower at this stage. And we're also seeing that on the weekly chart, if you get my weekly charts that I send out. So at the moment, I would still sort of watch the resistance area I gave back in June for any rally was sort of the 108.25, 110 area was the maximum it should sort of do and move back up towards that long-term trend line. But I think I would add a couple of levels in now. I put in 106.75 as resistance and 107.60 as areas to watch on the monthly closes. And it really needs to get above those to start to get some positive feel back. At the moment, I think it's in neutral. It's turned from being very negative just to neutral. It hasn't turned positive. Because of that broken trend line and the dramatic move lower from that trend line, I still think overall the market is looking stronger dollar. So where would it be a trigger, shorter term, that actually we're going lower. I think if you see 101 below that on a weekly close, then I think that opens the way lower. But while it can hold above 101 on the weekly close, you have a chance of a rally in euro dollar to those levels I mentioned. And you will get these levels sent out, and everything that I'm saying will be written down. So hopefully that will help. So if we go to the next slide, we're going to look at the sterling index. Now, this is one of my favorite charts. As you know, if you've been watching this, it's just worked so well since the 2015-2016 collapse. Every quarter has not managed to close above that 38.2. But if you look, you have that blue dashed line going up. So what that shows is that the dips each time have been being bought on a quicker basis than they were before. Now, the trouble sterling has is the last few sessions. So if we go back 3, where I put that little red writing, that says bearish outside session. So you had a bearish outside session a couple of quarters ago, and that led to another negative quarter last quarter. Now, this quarter is going to be crucial because it's right on that trend line. So are people going to still see sterling as, yes, we should be buying it longer term? Or is it going to be a break of that 23.6, which is 62.3, and that trend line, which would open a significant fall in the value of sterling? Now, it's uncertain at the moment because, look, price action is hovering right on that trend line. So that's something we need to keep an eye on. I will keep you posted over the next coming webinars, but that will be key going into later in the year. Can it get a push off? We need to see, if you want a stronger sterling, you need to see that trend line, you need to see that 23.6% hold. Any clear break below that isn't good for sterling. So at the moment, you're still in neutral mode, having not triggered positive mode. You haven't triggered negative mode. But look at it, for the last 7 years, all it's done is basically gone sideways. So how does that affect the currencies we look at? So let's start with sterling dollar on the next chart. So sterling dollar has had a very large collapse, but that's not sterling moving. That's the dollar. We've been looking at that dollar index. So we saw that big move down in sterling dollar, and that goes with the massive move up in dollar index we saw over the last year or so. And then the last bit here, we see a spike down below sort of the 120 area, but it came back up. And that is following through from that move off the dollar index where price fell off the 76.4. So in June, I was saying you need a clear quarterly close below 124.60.90 to open the 113, 114 area as a target. And that actually happened. Oh, I think we've gone slightly right. Here we are. So that actually happened. So I do believe there is now a potential risk of 113, 114 as a long-term target, not an immediate target now, but a longer-term target. So do I see that happening in the short term, medium term? No. And why is that? Because of the spike. So the spike last month and falling off that 76.4% in the dollar index, that's what's rallied sterling dollar up. So I think I would look at 118, 120, and while sterling dollar can hold above that, then maybe there's a chance of a rally up towards the 125, 127 area. But I think it will start to struggle to get above that 125, 127. If it did get above 128, then that would put on pause that 113, 114 for a longer term. So if we look at the next slide, this is another reason why I think sterling dollar will be going up. Now, this is my weekly chart. I put this out this week and also last week, and both weeks I highlighted the positive divergence. So that shows you the strength of the move was lagging, and that normally precipitates a turn. And now we're seeing that turn. The other line I put on back in June on those weekly charts was 118.70, and we've had no weekly close below that. So that's the trigger for me. You get a weekly close below 118.70, things aren't looking good for sterling dollar. While it can hold above that area, then maybe up towards the 125, 127 area. Now, I hope that helps with sterling dollar. And if we move to the next chart, we're going to look at euro sterling. Now, Neil assures me that some people don't look at this euro sterling chart at all, and they only look at sterling euro. So today, I'm going to make sure that I cover both. So on euro sterling, back in April and June webinar, I was looking for a rally, and I said euro sterling, the rally should find resistance in the 86.50, 87.50 area. And if you look at that chart in that last ringed area, you can see that's exactly where the market stopped. It stopped between 86.50 and 87.50. And the fall off it last month was very sharp. So that's another perfect rule of the rule of polarity. So if you look back at all those circles, and when you get the charts, hopefully you can look at this and see this, support turns to resistance and resistance turns to support. And this area here, 86.50, 87.50, for the last few years, whenever it's got up to that after breaking one way or the other, it finds it as a tough area. So it went up to that area, it's fallen off. But what now? It's fallen off. Is this the start of a stronger move lower, or is it going to bounce back up and attack that area again? Well, for me, there's a key area to watch, which is quite small, which is 83.06 and 83.25. So the 83.06 comes off the 38.2% extension swing of the initial move lower here. And so while price can hold above 83.06, 83.25, maybe it can get a bit of a rally. But why do I say 83.06? It's on the next slide. We look at the next slide. This is the weekly chart that I send out. You'll see that we had a downtrend line. Price has come back down, and the 76.4 comes in at 83.25. And that also, it could be a retest to the old trend line. So this is a really key area for euro sterling. This 83.25 is key. If it breaks below that on a weekly basis, I think you go down towards the 80.50 area, 80.60 area pretty quickly. Now, if you look at the next slide, this is sterling euro. So let's, as promised, for those Neil assures me like sterling euro, let's talk sterling euro. So in the April and June webinar, I said the move lower would find support in the 114.30, 115.60 area. And if you look, that's exactly where it bounced, in that 114.30, 115.60 area. Again, the rule of polarity, as we spoke about on euro sterling, exactly the same. So we've got a bounce off there, quite a sharp bounce last month. But again, the 38.2% extension swing is holding it at the moment, and that's 120.12. So above 120.12 would really open probably a move up towards 123.50, the 61.8%. But again, it's not just 120.12, it's 120.20, 120.40. If we look at the next slide, this is the weekly chart that I've sent out on my weekly distribution yesterday. Look at the trend line. So there's a trend line. You're retesting the trend line. You've got that, you're in between the 61.8%, 76.4%. So really, watch that 120.20, 120.40 as resistance. If that holds it, then we could see a move back lower off this trend line. But if you get a weekly close above 120.40, I think you're up to that 123.50 probably quite quickly. Now then, the last thing I was going to look at here on the next slide was maybe have a look at Brent oil, because this is something we were looking at before, and I know oil is important to a lot of people. We had the long-term trend line that broke last year. And this slide is just to show you the long-term trend line. Now, if we look at the next slide, I've zoomed into the last bit of this slide to make it clearer. Have we got the next slide, please? That's it. So you can see again that trend line going across. Now we've zoomed in. And you can see that back in 2021, when the market broke that, it acted as support before rallying up. But what happened 2 months ago? Well, actually, let's just put into it. We had the first impulsive move up, the pullback, that pink arrow, then the pullback, then the extension. Now, it did the 100% extension, and we can see that 100% extension up to 136.44. Then it's pulled back off, gone sideways. But 2 months ago, you had a harami month. So that is where the body is completely within inside the candle before. You'll see this much clearer when the charts are sent out to you if you can't see it now. And so in Japanese, that refers to a pregnant person. The body is inside the mother. It gives birth to a child. And it says that the child always goes in the opposite direction to its parents. And so you can see prices coming down now. So yes, at the moment, it's looking negative in the short term. But I do feel still that as moves come down here, especially hit into the 80, 90 area, there should be some buying interest start to unfold. And you might see that start to come back up. At a push, it might get to the 70. But I really think in those sort of areas, longer term, it turns back into the buy. And if we get above that 136, I would target 163. If we got above 136.44, that 100% extension swing.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.